Our next guest is Justin Hollis from ABAX Investments. Justin, welcome.
Yeah, great to be here. Thanks, Neil.
Thanks so much for joining us. Justin is a portfolio manager at ABAX Investments. They manage the Nedgroup Investments Opportunity Fund. So, Justin, let's jump straight into it. Performance has been magnificent, if I can put it that way. Do you want to talk us through the numbers quickly, please?
Yeah, perfect. So, Neil, I'll draw your attention to this first slide here, which details the performance of the Nedgroup Investments Opportunity Fund relative to that of its benchmark, being CPI plus 5%, as well as the peer group. And we certainly are very encouraged by the performance of the fund. It's very interesting to note that the fund has significantly outperformed its CPI benchmark over both the short term as well as the long term since the fund's inception. We're also encouraged by the performance of the fund relative to its peer group. If I think back to the last year, a lot of that performance has been driven by our exposure to risk assets. So both domestic equities and foreign equities have performed very well. In addition to that, our structured notes as well as our SA bonds have performed well.
And Justin, what about on a risk-adjusted basis? Have you managed to keep fund volatility down while delivering these good returns?
Yeah, that's a great question. So risk is something that we do focus on with a great degree of attention at ABAX, and we do aim to achieve very high risk-adjusted returns. You'll note on this slide here, which details that relationship, and we're very encouraged by the very high Sharpe ratio that the Nedgroup Opportunity Fund has achieved, notably higher than that of the peer group as well as the JSE SWIX. I think the wonderful thing with a multi-asset fund such as the Opportunity Fund is that you do have a toolkit which allows you to achieve this objective. So it's principally done through active asset allocation as well as security selection. But in addition to that, you've got other avenues to add value, such as through hedging, currency hedges, as well as structured notes.
Yeah, I actually want to kind of dive into that multiple sources of alpha approach a little bit more. I mean, maybe if we can talk about the last year specifically, I mean, how are we able to deliver returns?
Yeah, perfect. So let me draw your attention to this slide here, which is an attribution analysis, which details the key contributors to returns over the last 12 months. On the left-hand side, you'll note that it references the different asset classes, and on the right-hand side, those single positions that enhanced return over the last 12 months. So if we focus on the left-hand side first there, and as I mentioned earlier, it has been a great time to be exposed to risk assets. So we've seen significant contributions from our exposure to foreign equities as well as domestic equities. In addition to that, our domestic bonds were also a positive contributor over that period. If I draw your attention now to the right-hand side of the chart, which details those key positions that worked in our favor, you'll note quite a broad range of single positions that enhanced returns over the last 12 months. Top of the list being TBC Bank. This is a business that we have owned for some time and once again has been a key contributor. In addition to that, our exposure to SA bonds, as I mentioned earlier. Our platinum exposure has also enhanced performance, and it's a sector that is benefiting from increased supply deficits. Valterra Platinum being our key pick within that space. Quite interesting to note that we recently participated in the placement of Valterra Platinum shares, which had happened in September at a share price of 875 Rand a share, with the share price appreciating significantly since then. It's up over 30% since that placement. In addition to that, our exposure to Chinese tech, that this has been expressed through our exposure to Alibaba, Naspers, as well as Prosus. I touched on structured notes earlier with our exposure to the British American Tobacco structured note, also a key contributor over the last 12-month period.
Geez, that TBC Bank just keeps going. It just continues to surprise me. Justin, I want to ask you as well. So if you look at the SA market in particular, I mean, we've heard a lot today, even before you arrived here, about how well it's done, right, this year. And what are your thoughts on how much more it can continue to keep going?
Yeah, so as you did mention, I mean, the market has had an exceptional run this year. I think it's close to 50% up in US dollar terms. So it's only natural, I think, for investors that have been exposed to our market to start thinking, is this as good as it gets? Should we be reducing our exposure? But we believe now is not the time, despite the strong rally that we have seen in our market. You will note on this chart here that the price earnings multiple of our market still continues to screen very attractive, both in absolute terms and also relative terms, which is detailed in this slide here, with the SA equity market represented by the yellow line relative to emerging market, other emerging market, as well as developed market. So the South African backdrop has been characterized by weak growth for some time now, but we do think that there are some bright spots emerging. For example, our low levels of inflation, the stronger rand. We are anticipating additional interest rate cuts, so the market is anticipating about 75 basis points in interest rate cuts. In addition to that, we are starting to see some slow traction with respect to government reforms, all of which we do think translates to a pickup in economic activity and economic growth. So we do think that you are going to get a broadening of the market performance. I think on that point, you'll note that a lot of the strong return that our market has delivered this year has principally been driven by a very, very narrow subset of companies. And that's illustrated on this chart here, specifically the left-hand side. So about 80% of the market return has been driven by our commodity exporters, as well as the likes of Naspers and Prosus, with a lot of domestic-orientated businesses continuing to languish. We find many of these businesses trading at levels, both share price and valuation, where they found themselves at the heart of the local uncertainty, and at levels where they were trading pre the formation of the government of national unity. So what we find of particular interest is the disconnect that has emerged amongst interest rate sensitive sectors, specifically that between bonds and banks. Now, if I draw your attention to the chart on the right-hand side of this slide, you'll note historically there's been a very tight correlation between the price to book multiple of the SA banks relative to that of the inverted SA government bond yield. Yet a large disconnect has emerged recently, and on account of that, we have been rotating some of our local bond exposure into these South African banks.
I mean, it is quite remarkable how cheap these banks are appearing to be, but obviously you still have to be selective. And then, Justin, I guess if you look at central banks now, and probably we can use the Fed as a good example as well, markets, as we just spoke about, have done so well this year, but as you know, the Fed can completely flip things around. What are your thoughts on that at the moment?
Another great question. So we have seen a significant rally in global equities this year, and we do think that there are signs of investor complacency at the moment. I mean, some top of mind risks being the softening of the US labor market. In addition to that, we are yet to kind of really know the full impact of the changes in the global tariff regime. That being said, monetary conditions are a very important driver of equity markets, and we do anticipate that the market will continue to be supported by global banks continuing to cut interest rates. And it's quite interesting to note on this chart here, specifically that on the left-hand side of the slide, which details the relationship between market drawdowns and Fed fund rates. And you'll note historically, market drawdowns have coincided with an uplift in Fed fund rates, and that's certainly not what the market's expectation is at the moment. If I reference the graphic on the right-hand side of this slide, which details the Fed dot plot projected rates, you'll note that there's an expectation that there are going to be rate cuts of approximately 125 basis points through to the end of 2027.
Yeah, there's definitely quite a big shift in interest rates, which the market's going to have to deal with.
Yeah, and look, the Fed, I think, does find themselves in quite a tricky position at the moment, just in terms of trying to manage that dynamic of sticky inflation, yet a softening labour market. And it was quite interesting to note Chairman Powell, when he did cut the interest rates by 25 basis points at the September meeting, that he did note that it was a risk management move. Another very interesting, I think, point to note, just looking at that dot plot chart, is the significant divergence amongst the Fed committee members as they try and balance the softening labour market and inflation, sticky inflation in that market.
Yeah, with those competing priorities. So, Justin, I guess if I look at your kind of multi-asset investing approach, you very much want to take advantage of kind of valuation dislocation opportunities, right? Where are you seeing value at the moment, and how are you positioning the portfolio to take advantage of that?
Yeah, perfect. Well, let me turn to this slide here. You'll note that we still think that emerging market equities, especially China, still looks very interesting to us. I think in line with what I was speaking about earlier around the underperformance that we've seen from South African domestic shares, that's an area that screens very attractive. And should we see a pickup in economic activity, we do think that these businesses can flourish. I also mentioned earlier that South African bonds, given the rally that we have seen year to date, that we believe that these are no longer as attractive as what they were. So we have been rotating some of our South African bond exposure into those domestic cyclical opportunities, specifically the banking space. I mean, we do believe that disruption and uncertainty are likely to persist, but are very comfortable with the current portfolio positioning at the moment. We do think it will prove resilient given the range of possible outcomes that could emerge. And we'll continue to look for opportunities to capitalize on market volatility, as we did in April when we saw significant market drawdown following Trump's tariff announcements. So this slide here details the portfolio positioning as at the end of September 2025. You'll note on the left-hand side, you've got the split by asset allocation. So very well diversified portfolio at the moment. You'll note that the net equity exposures is sitting close to that 60% level at the moment. What's become an increasingly important part of that equity carve-out are our structured notes, which is about 19% of that equity portion. And then on the right-hand side, you'll note our top 10 equity positions. Once again, we flag TBC Bank, business that we do think continues to screen very attractive, notwithstanding the strong share price performance. You'll also note a few domestic cyclical businesses that are within that top 10 holdings, the likes of an ABSA, Standard Bank, Truworths. We also have meaningful positions in FirstRand as well as Capitec, although not represented within the top 10 holdings at the moment.
But even looking at your top 10, it's like actually quite a nice diversified listing of companies there, not particularly focused on one area.
100%. As I mentioned earlier, I think that we are operating in uncertain times, and I think diversification is key. So it's looking for opportunities, different industries, different sectors, different geographies.
Great. Justin, thank you so much. Nice having you here, and thank you so much for joining us.
Yeah, thank you. It's been a pleasure.